In this video, I'm going to walk through some unique circumstances or differences with journal entries and T accounts for a manufacturer versus a merchandiser or a service company. Before I jump into the specifics, let's just refresh ourselves briefly on the rules of debits and credits. And recall, for any account, the left-hand side is a debit, whereas the right-hand side is a credit. And debit or credit doesn't necessarily mean, in accounting, increase or decrease itself. It depends on what type of account. So you may or may not have been exposed to the acronym ADE, LOR, but it can be helpful in remembering the rules of debits and credits. Assets, dividends, and expenses are all increased on their left-hand side or their debit side, and decreased on the right-hand side or their credit side. Whereas liabilities, owner's equity, and revenues are all increased on the right-hand side or the credit side. And I want to note that owner's equity, what I mean by that is the two major components of retained earnings, profit retained in the company, and common stock or investment by our stockholders. That's what owner's equity includes. Now that we have a refresher, let's go ahead and start building some of our journal entries. So we have a company here using a job order costing system. So therefore, job order costing is specific to a company with unique products. The company is going to start out and purchase raw material on account for $210,000. We're increasing our raw materials. Raw materials is an asset. It's increased by debit, so we're going to debit raw materials for $210,000. They don't mention that we're paying cash, so we're not going to credit or decrease cash. When they say buying on account, it implies that we haven't paid yet and we've got an IOU to our supplier, and that's going to be represented by accounts payable. Remember, accounts payable is when we owe someone else. Accounts receivable is when they owe us. Accounts payable is a liability. That liability is increasing. That's going to be increased on our credit side by $210,000. The other thing that they ask us in this situation, beyond doing our journal entry, is posting this to our T accounts to get an up-to-date account balance for any of our accounts. Now, in this particular problem, they just ask us to post to two different accounts: manufacturing overhead and work in process. I'm going to go a little farther than the problem requires, because I know on the exam it goes beyond being able to post to your manufacturing overhead and work in process. And I'm going to go ahead and post to any of the inventory related T accounts. So we've got our raw material, which is an asset. One form of inventory, it's materials we've bought in from suppliers that we haven't yet done anything with. Another inventory account we have is work in process. So that's we've started work on the product, but it's not yet finished. And our third inventory account is going to be finished goods, so product we've manufactured but haven't yet sold. Another account is going to be a temporary account. It's not an inventory account, but manufacturing overhead. And we'll deal with that in a minute or two. So let's go ahead and post our first journal entry. Recall, it's a debit to raw materials. That debit is going to go on the left-hand side. So now our raw material account, if we had shown the balance, would have a $210,000 debit asset balance. Now, I don't have the T account listed for accounts payable. It would have been posted to the right-hand side and updated the balance at $210,000. I'm going to go ahead, now that we bought raw material, jump back to our transactions. We're going to use those raw materials in production. And in fact, we're going to use $190,000 worth of raw materials. But we're going to use it for two different purposes. Part of it's going to be direct materials. Recall, direct materials are something we can easily trace. The other part of it may be things like supplies, which are indirect and aren't easy to trace. So we're going to have to split up this journal entry. And we do credit or remove or decrease $190,000 from our raw materials. But you can see we're putting it into two different accounts. The $178,000 that is direct can be traced now that we're starting to work on the product. It goes from raw material we haven't touched to work in process. We have done something to it. We're going to increase work in process by $178,000 for the direct materials. But recall, $12,000 is indirect materials. And if you recall from chapter 1, indirect materials are part of manufacturing overhead. So we're going to increase manufacturing overhead by $12,000 for those indirect materials. Manufacturing overhead functions like an asset, expense, or dividend because it's increased by debit and decreased by credit. But it's not an asset, dividend, or expense. It's a temporary account we only use during the manufacturing process. And eventually, we'll see in a future video, we need to clear that out. But I don't want to add that complication here. Just know it's increased by debit. So let's go ahead and post this journal entry also. So we're going to debit or increase work in process. I'll note the problem told us that work in process had a beginning balance of $42,000. Since it's an asset, it would be a debit balance. We're going to increase it or debit it on the left-hand side, but an additional $178,000 for the direct materials. Manufacturing overhead is going to be increased by $12,000 for the indirect materials. The last thing we need to do is credit on the right-hand side our raw materials. Remember, when we calculate T account balances, we're going to take whatever side is the smaller side. Here, that's a credit of $190,000. Subtract it from the larger side, which here is a debit balance of $210,000. Since the debit balance is larger than the credit balance, our resulting balance in raw materials is $20,000. So now we've used some of the materials directly into work in process, some for manufacturing overhead. We've got $20,000 of raw material left. In the interest of keeping this video as brief as possible, so it's not a huge 20-30 minute video, I'm not going to step through each individual journal entry that's part of this problem. I do think your textbook gives a pretty good description, not pretty good, really good description of each journal entry, but I just want to point out some highlights as we go through. For example, what would manufacturing overhead look like after you've went through all the journal entries? And I just want to highlight a few things here. Note, I already mentioned Journal entry B, the $12,000 included the indirect materials as part of that second journal entry. But I can start to weed through our other journal entries we would eventually post to. For example, C is where we had indirect labor of $110,000. So it may include things like custodians for our plant, our supervisors, maintenance workers, and things like that. Beyond indirect materials of $12,000 and indirect labor of $110,000, we have some other additions to manufacturing overhead. So if you go back to D had to do with depreciation related to our factory. So you probably were familiar from financial accounting where when you recorded depreciation, you debited depreciation expense and credited the contra account accumulated depreciation. Hopefully that sounds familiar. The credit is still the same, but the debit changes depending upon whether it's related to a manufacturing. So it'd be part of manufacturing overhead if it was factory related. It would only still be depreciation expense if it wasn't manufacturing related and it was related to selling administration. The other increase to manufacturing overhead is going to be for journal entry E, where we have some other miscellaneous catch-all things like we might have electricity costs and stuff like that that's included as part of manufacturing overhead. So that's all our increases. We have a decrease though to manufacturing overhead related to F, where we say, okay, all the actual costs get debited to manufacturing overhead, but we apply overhead based on an estimate. Remember that predetermined overhead rate, and we're going to apply the $240,000 of manufacturing overhead, and we're finally going to apply that to work in process. Keep in mind all those manufacturing overhead costs first get accumulated within manufacturing overhead as indirect cost, but eventually get applied to work in process based upon an estimate that predetermined overhead rate. We have some other increases to work in process here beyond applying our overhead. Remember, 3 different manufacturing costs. One does include manufacturing overhead, but the other is the direct materials of $178,000 from our second journal entry, And also, if you work through your third journal entry or C, it's the direct labor of $90,000. Including the beginning balance of $42,000, that's all our additions into work in process. G is when we finally say, hey, we finished some product. In fact, we finished $520,000 worth of our work in process incomplete goods and added those into finished goods. That has a special name you'll eventually see in a future video, and that's called cost of goods manufactured. So it's a fancy way of saying what's the total material, labor, and overhead costs related to goods that are no longer incomplete and part of work in process and get transferred into finished goods, that $520,000. I'll note once we subtract that $520,000 that we complete from our beginning balance and additions into work in process, it leaves $30,000 worth of goods that are incomplete. Finished goods. So we have the addition of our cost of goods manufactured of $528,000. We also have our subtraction for finished goods, and that's going to be our cost of goods sold. So $520,000 added in, $480,000 subtracted out that we sold to our customers, leaves a resulting balance of $40,000 in finished goods. And I know the finished goods wasn't one they asked you to calculate, but again, looking ahead to the exam, it's still important that you know how to do that. Again, the $480,000 is what we call cost of goods sold. So now we're finally expensing the inventory. I know cost of goods sold doesn't have the word expense in it, but it is expense of $480,000. Just a quick note, in a future video you'll see this. Manufacturing overhead is a temporary account. Right now it would have an $8,000 credit balance. As a temporary account, we'll need to clear that out before the end of the period, and in a future video I'll show you how to clear that out. But at least we've covered some of the basics of our journal entries for a manufacturer at this point.